Hello, everyone. It's Lorenzo di Mattia, manager of Hedge Invest Sevilla Macro Fund. I wanted to go through January, the performance, what we had done, and the outlook for the rest of the year. January was a frustrating month because despite our bullish view on risk assets, tactically at least, the implementation and basically taking the long side was extremely difficult because of the unpredictability of the Fed. The Fed has been completely unpredictable. We actually expected them to get more dovish during the course of the first quarter, but we expected them to do so gradually and on an additional weakness of risk assets and economic data. Instead, already in January 4th, way before the first meeting in January, they completely changed the outlook for interest rates. In December the 19th, they said they would raise rates twice. In January 4th, they said they wouldn't hike anymore, basically. And then they gave another misleading statement then, because they said quantitative tightening would still be ongoing until further notice. And this statement was reiterated in details in an interview mid-month when Powell was interviewed specifically on the balance sheet and said the Fed wanted a significantly smaller balance sheet. So just when we were formulating our outlook for currencies and risk assets, which was not as bullish, and it was dollar bullish, at the end of the month, the Fed again changed completely because they issued a special statement on the balance sheet saying they would actually stop quantitative tightening a lot earlier. Now the question is when, but surely it's a lot earlier than it was supposed to be just 10 days before. So it's been very hard to construct a portfolio, and right now we're sort of neutral. We believe the risk reward is pretty much neutral, actually a touch more downside. We expect possible additional upside in the S&P of about 5% to 2,800, based on especially the potential catalyst on the trade deal with China and China stimulating, and downside of 5-7%. This is in the near term. So we're mostly in cash right now because we don't believe the risk reward is appropriate. But if there is a small correction, we would take the long side. If there is an additional rally without a pullback, we would take the short side based on our longer term view. Our long term view is bearish, and it's based on two simple factors: peak earnings and global slowdown, which are real. And we believe earnings in the U.S. Are peaking now, and the peak that we're seeing now will remain the peak for a couple of years. So the only question will be how far and how fast earnings will decline in the next 2 years. But we think that is also a possibility that there will be discussion about a reversal of the tax cut, because Trump, need to compromise on a lot of things, and this, together with a global slowdown, will overwhelm a dovish Fed and a trade deal with China, and risk asset will go back down, at least to the lows that we've seen in December. So there will be a lot of opportunities intermediate term. Hopefully, the Fed becomes a little more predictable, but we are also learn from experience, and we're planning better for the completely unexpected outcomes. We're neutral on the dollar, and we're looking for an entry point in U.S. Treasuries. Thank you very much.